Start your day with It's the Business. Here's Phil Dobbie.
Well, today, as governments around the world rack up massive debts to pay for COVID-19, the obvious question is, how are they going to pay for it all? Well, we know the interim solution. Governments issue bonds to cover those debts, and the central banks then buy them all up. But what happens then? Do they hold on to them? We talked to Paul Cavanagh, CEO of investment management firm Petronus Partners, about what this is all doing to the finance markets and how we and the government and the central banks get out of this, if indeed they have to.
The debt is just getting bigger and bigger. And the reason why we haven't completely blown up at the moment is that interest rates are pinned to the floor. So financing the actual principal of the debt is manageable, but addressing the principle is something that's not manageable through tax.
Well, let's hope Rishi Sunak knows that. Plus today's papers, we'll look at that. And the Jaguar Land Rover story, they're going all electric. Well, obviously, everyone has to go electric because you won't be able to sell diesel or petrol cars in this country soon. But aren't we missing the elephant in the room in all of this? This morning, let me introduce you to the elephant. It's Tuesday, it's the 16th of December 2021. Welcome along.
And now, it's the business, making sense of it all with Phil Dobbie.
And belatedly, welcome to the year of the ox. The Hong Kong Stock Exchange has opened up the new year by rising above 30,000 points, and it's back above pre-pandemic levels. So many things now are getting back above where they were before we went into this horrid thing. It's all reflation talk, isn't it, in the markets right now? Things are getting back to normal. The pound was on the rise yesterday. The FTSE 100 rose 2%. After Rodney Hobson was on the podcast yesterday morning saying it was undervalued, it rose over 2%. We have such power on this podcast. But there is clearly a lot of optimism out there that life can get back to normal exactly as it was before if we ignore the small issue of government debt. If we ignore the fact that the government, by December, had racked up about £2.1 trillion in debt. So how do we pay that back, or do we need to pay it back? Well, Paul Cavanagh joins me this morning to talk about just that, and he's not the only one wondering. The Japanese finance minister is saying, well, it's hard to tell what the appropriate debt level is, and they have lots of it. I mean, they had over 200% of GDP back in 2010, and it's just kept rising since then. Mel Stride, chair of the Parliament Treasury Committee here in the UK, he obviously thinks we do need to pay it back. Has been talking about a wealth tax as one way that we might cope with the rising amount of government debt. I'll tell you, we're going to discuss that and why that is the wrong thing to do, unless he wants to do it just to try and reduce the rich-poor gap. But if it is to try and raise funds to help out the government's coffers, totally the wrong idea. And a consequence of governments cutting back on spending is we start to do stupid things like this. We don't pay money into the institutions that need them, that make our society richer, like the Metropolitan Art Gallery in New York, the Met, has got a $150 million shortfall because, of course, they're not getting any ticket sales. You'd think, well, hopefully the government would just step in and sort that out, 150 million out of all the trillions that they are borrowing. But no, instead, for the first time, they're going to start selling paintings to recoup their losses. So that is one sore that we will see at the end of this, one wound. A gaping wound at the end of all of this is that there will be less artworks on display, which is all rather sad, isn't it? Whilst the less rich and rewarding aspects of our lives, the art of selling houses, is something you can now study as a 16-year-old in Australia. They are house obsessed in Australia. Real estate is going to be one of the high school certificates over there, which is the equivalent of A-levels over here. And normally they're not vocational. Normally, it's like we do here, maths, English, history, maybe economics, if you want to study fiction. I wonder, now they've got this. You're going to learn how to sell houses as a 16-year-old. If you lie about the state of the house, you get a distinction. So nothing to do with that or anything else we've been talking about today, but I just thought this was interesting. Nestle are going to introduce a vegan Kitkat, and they're going to test run it in the UK. I'm not sure what that's going to taste like. How do you make chocolate without milk, particularly on a Kitkat? Because they get that very distinctive taste by using the milk of a cat. That's how it got its name. No, not really. But, how do... it would be a very lengthy process, wouldn't it? But really, how do they? It's soy milk. It's not quite the same. Is it really? But if you're vegan, good luck to you. You've got your wish. Jaguar Land Rover yesterday said they're going to stop producing internal combustion engines. Instead, it's going to be all electric, and maybe they're going to try a bit of hydrogen as well. No surprise there. They're going to stop making them at their Castle Bromwich factory. There's been a question hanging over that factory for a long time. A lot of it related to the Brexit impasse, but it's now going to stay open for special operations for now. Special operations. That sounds like just a stepping stone to closing down altogether, doesn't it? That sounds like, when you're in a company and they give you a job with a title strategy, the strategy manager. That is just a stepping stone to the phone stops ringing when you've got that job title. It's just a stepping stone for you being out. Well, I think maybe that's the same for the special operations factory. But look, obviously they are getting rid of everything but electric cars, because Boris Johnson has said that petrol and diesel cars can't be sold in the UK after 2030. But I just wonder whether we're going to be ready for it, because that is, he will obviously announce the plans of exactly how this is going to work in December 2029. Just a month before it all kicks in, based on past form. If he's still Prime Minister, then we assume not. But, this is only a little under 9 years away. It's going to get pushed back, isn't it? Because I did some back of the envelope numbers. And look, we've got, if you look, we just won't have the capacity, in short, to charge up all these vehicles. We drove 330 billion miles in 2019. Obviously, last year was a bit different. And we used 8 billion gallons of fuel, which means we're averaging, I've done the maths already. Here's some maths I've already done. Just get it out from under the table. We did 36 miles per gallon on that basis, which sounds about right, doesn't it? And if we said the average fuel tank is about 11 gallons, what's that, about 40 litres, 11 gallons, then the average fuel that a car has a range of, a fuel car would have a range of 36 miles per gallon and 11 gallons in the tank. So we're getting close to, you could drive for 400 miles. But let's say you drive 350 miles before you fill up your car on average. That would mean 940 million visits to a petrol station to reach that 330 billion miles that we're driving each year. With me so far? Now, there's 8,400 petrol stations in the UK. So on average, each petrol station would make 112,000 sales a year to meet that 940 million total. So that is per petrol station about 310 sales a day, which sounds about right, doesn't it? Really, this is all very plausible. Now, with electric cars, rather than a tank range of 350 miles, and rather than being able to go 350 miles before you have to fill up, let's say that they've got a range of 175 miles, which is half the range of a car filled with fuel. That is actually a lot more than most cars, but let's assume the technology moves on to 175. So we'd have to charge up twice as often as we filled up. And when we go to a petrol station, let's say it normally takes 7 minutes. Now it's more likely at best to be, well, let's say 21 minutes. So it's 3 times as long. So you've got twice as many visits, each 3 times longer, which means you need 6 times the charging capacity versus our current fueling capacity. Could we do that? I suspect not, because we've got 8,400 petrol stations. But if we had to have 6 times the number, 6 times the capacity, that would be 50,400 petrol stations, or what are now going to be electric charging stations. And these are, and when you think in a petrol station, you've got, 8 pumps? So you've got to multiply that 50,400 by 8. You're going to get about 400,000 electricity charging stations that we're going to need. Right now, in the UK, we've got 20,000. We've got a way to go in 9 years, haven't we? So that's the elephant in the room. How are we going to meet the capacity for all of this? So there we are. There's some sums early in the morning. Oh, my head hurts after all that. Now we are going to talk to Ian Cavanagh in just a second. First, let's have a quick look at the newspapers this morning. And if you've ever wondered what Simon Calder's feet look like, Simon Calder is, of course, the independence travel writer who's just in the media everywhere at the moment, but I've never seen his feet. But today they are front and centre on the front page of the Independent. Simon Calder inside a quarantine hotel, which it looks quite nice. It's not exactly Starlog 19. He's helping himself to a nice cup of tea there. Isolation row he's in, they're saying. Also, Boris Johnson not pandering to the backbenchers who want things to move back to normal quickly. He says, I want this lockdown to be the last, vows Johnson. That's the front page of the Independent. Pretty much the same story on the Daily Express. We can be optimistic, but no time to relax. PM. So that's on the front page of the Express this morning. The Eye is reporting on the farce of the hotel quarantine, with saying immigration staff were emailed red list rules just 3 hours before the rollout in England, and the fact that high-risk passengers were still able to mix freely with other travellers upon arrival. They were standing in the same queue, so it sort of negates the point of whisking them off, doesn't it, to a separate hotel in quarantine. The damage could already have been done while they're queuing up for customs. The Daily Star, publicity-shy couple to tell all to Oprah. Yes, really. This is because Meghan and that red-headed chap that she's married to are Harry. That's his name. How quickly we forget. They're going to do a 90-minute tell-all Oprah TV special. That is also the front page of the Daily Mail. Harry and Meghan, the final straw. They agreed to 90-minute tell-all. As royal sources say, there's no way back for official duties. They're gone. And the Times. Let's get back to the good news. Vaccination is reducing admissions and deaths. New figures suggest jab also cuts transmission. Well, that's a relief, isn't it? So we are on our way to the sunny uplands. Hurrah! And more about Dominic Cummings in The Guardian. Anger over Cummings' role in COVID contract. This is the fact that he basically awarded a contract to a bunch of his mates or his friends, a company called Public First, which is a research company owned by two of his long-standing associates, and they were basically paid more than £500,000 for the work that they did for the government. Nice if you know the people in the right places, isn't it? And in the other papers, yes, the final lockdown. Johnson, this must be the final lockdown in the Daily Telegraph. The final lockdown is the front page of the Metro. Everyone's lacking imagination in the copy editor's room this morning. The Financial Times, this story we've already covered. JLR ditches diesel in plans to go electric within 15 years. So there we are. That's what's happening in the newspapers this morning. You don't need to buy them now, because we've told you.
It's the business, making sense of it all.
With Phil Dobby.
Now, we talked about shares yesterday, which sectors might do well as we come out of COVID-19's crisis, and whether UK shares are undervalued as a whole. But right now, it's not just shares that are going up, is it? Oil is going up. Government bonds are going down in price generally. That means yields are going up. Investors are buying junk bonds too. Companies they normally wouldn't touch with a barge pole, perhaps because, you know, everything is giving a return at the moment. And if you've got money, is this an easy time to make money? It seems like it, doesn't it? Although, we've also got rising government debt, but that doesn't seem to matter. If you look at Japan, for example, one of the most indebted countries there is, their Q4 GDP came in at 3% Q on Q, an annualized growth of 12.7%, doing better than most. The Nikkei topped 30,000 for the first time since 1990 yesterday. So no concerns over government debt there. Mainly because, of course, it's all being bought up by the supposedly independent Bank of Japan. Paul Cavanagh is CEO of investment management firm Petronus Partners. PetronusPartners.com is their website. He joins us this morning. So we have rising asset prices across the board, particularly in the US right now. It seems everything is going up. Shares, commodities, bond yields, real estate. What's going to turn first, Paul?
Well, it certainly feels like asset prices are melting higher. And can we tie it all into economic prospects? I don't think we can. What we can tie it into is the backdrop that has been really impacting on financial markets now for years, which is this sort of increasing debt burden. One can actually sort of argue that we've been living increasingly with budgets, deficits at the government levels for some period of time now. And
since the global financial crisis really is when it really took off, isn't it? Really,
I think what happened with that was that you had trends that were in place anyway, but when you had the global financial crisis, it really accelerated that trend. And you can argue the same with the pandemic, that the pandemic itself really accelerated trends that were already in place. And so the net result of that is clearly that we have this debt burden that needs addressing, that needs to be dealt with. Now, in the near term, the focus is on survival. It's about survival of the economy. with enforced economic closure, you have a number of choices here. But really, what we've seen in the central banks is that we've got to pump a lot of money into the system here to try and tie and bridge people over these difficulties that we face. But going beyond that, what we can see is that these debt burdens, how are they going to be addressed, and what measures can be put in place? And I think financial markets, from their perspective, see that that's going to be a very difficult situation to resolve. Interest rates are going to have to remain lower for longer. Continued support from the central banks. That money coming into the system is going to come into the financial assets, and that in itself is what I think is helping to drive markets higher.
So governments, central banks, obviously are buying up government bonds like there's no tomorrow. I mean, a huge percentage of all the government bonds that are issued. I love the fact that everyone talks about central banks being independent, but basically they're buying up almost anything the government wants to issue right now to try and get us through this. So I mean, the issue is how long do they hang on to those? I mean, and will they ever? I mean, they're sitting on the balance sheets. The idea is at some point they're going to sell them back to the open market in the hope that people are going to buy them. Is there going to be the appetite? And what will that do to interest rates if you start offloading, these billions or trillions of dollars worth of government bonds on the open market?
Well, I think the question starts is when will we be at a stage within an economy where we can start to repay some debt. And I think that the point that we've tried to sort of address here is that linkage between taxation and spending, which ran either a budget deficit or a budget surplus in times gone by, has been broken. I don't think anybody is now could come in with a mandate to say that I'm going to run a neutral budget or a budget surplus, because really what we've seen is that the take from the economy to fund the debt is just getting bigger and bigger. And the reason why we haven't completely blown up at the moment is that interest rates are pinned to the floor. So financing the actual principal of the debt is manageable, but addressing the principal is something that's not manageable through tax. And I think we can fast forward the tape. I think we can look forward here and think to ourselves, well, if you were Chancellor, where would you go for your tax take? Where would you start to increase taxes at the moment? Because what we've seen since the great financial crisis is that every time they start to push in a direction, whether it's for monetary or for a little bit of political movement, it tends to weigh very heavily on the system, to the point that the actual receipts from that tax can fall. So you take capital gains tax, you take stamp duty on higher end housing, for example. These are all sort of easy moves that a chancellor can make to say, well, we're going to tax the rich and the wealthy and the higher property and those that earn capital gains tax. But of course, does it really change the number for him? No. The big tax increases, the ones that are the income tax, the VAT, the things that affect everybody, any small nudge higher on that at the moment, and you're pushing on a system that really can't take it anymore. And so therefore, this linkage between taxation and spending, I believe, is broken. And that then leaves you with the dilemma of, well, how are you going to address the debt?
Well, yeah, okay. And I want to come back to that in just a second, because it sounds to me like what you're talking about is modern monetary theory. But let's just park that. Just going back to tax for a moment, because there is a lot of talk about whether they are going to up capital gains. The Institute for Public Policy Research is saying if you just treated capital gains the same as any other income, so the top band is 45%. Then that would reap quite a lot of money back for the government. And I imagine, there's a great deal of simplicity there. But your point is that really going to achieve anything?
What you really want at this stage is that we have an economy that is 10% smaller in 2020 than in 2019. And in fact, if you look over the last 10 years, what has our economy really done? It's not really moved forward. It's been a gradual creep of cost inflation that has like stealth-like has weighed in on people's income to the point where it suddenly became more expensive to maintain lifestyle. And therefore, that's been the process of the last 10 years. What this country obviously needs is reinvention. It needs new green shoots of growth It can't rely upon the old industries, and that equates to investment and entrepreneurialism, and therefore you can't be in a position where you're going to tax heavily that entrepreneurial spirit that comes at this stage. It's getting that balance right. Yes, one can sort of equalise some CGT, and I don't think anybody who makes gains is avoiding wanting to pay a little bit of tax. On it, but if you put your tax rates up at 45, 50%, so saying, well, I'm taking all the risk here, but I'm going to give half away if I make money, it doesn't incentivize that money to be invested. And we need invested money now. This is what we need, is to create these new areas of growth for the market. So getting that balance right is critical.
So this disconnect between how much the government is bringing in, you called it the intellectual chord in a blog on your website. This is why I really wanted to talk to you. The intellectual chord that links taxation and spending will have been severed or has been severed. I looked at that and I thought, so you're talking modern monetary theory. This idea that we create as much the aim. Modern monetary theory in a nutshell is saying, well, the aim of the government should be to ensure that everyone is fully employed. Whether that's achievable or not, I think is a big question mark in this day of automation. But anyway, that the government should be creating as much money as it needs to achieve that aim. And how that's applied, I don't know. But they certainly are creating a lot of money at the moment. The central banks are buying it up. So do you think the central banks should just hang on to it or just write it off? It shouldn't go back onto the open market. Is that how we address this disconnect?
Well, I think that the economics are going to force the hand rather than judgments being made at this stage. And what I think the message that's going to come through, whether you'll be a central banker or whether you're going to be the chancellor at the moment, and how you're going to run this is that we want to get back, and obviously fiscal prudence. We want to get back into a position where we're rebalancing the books. My argument is that we're some way away from the day where that the reckoning becomes more of a reality, because I think a lot of the noise that we hear at the moment is nice to hear, but I don't see it being played out in public, because every time that they wish to push in a certain direction, it's going to prove unsuccessful, and it's going to weigh on society too much as it's trying to recover from the economy. So I think the reality is that the Bank of England won't be in a position to be putting this back onto the market. It'll have to roll over the debt, to continue to extend the debt. When we're running budget deficits of 400 billion for the period to 2021, what's the number going to be for 21, 22? It's probably a number that's north of 200 billion. It could be back up at nearly 300 billion. These are enormous numbers. We went to the great financial crisis with £1 trillion worth of debt, and we've probably racked up 600 to 700 billion, 60 to 70% of that in this 2-year period alone. And of course, we don't know what the economy is going to look like, how it's going to bounce back. It's warm words at the moment, but we've changed practice in so many ways. People have become used to sort of more home living and not going out and entertaining so much and spending. Do they just change back to the old days, or have things sort of migrated into new? The reality is that we know so little about how things are going to unfold at the moment. So when I hear the noises, I think it's important to remind everybody that at some point this will need to be addressed. How it's addressed, I don't think first of all, one can't default on the debt. Secondly, can we raise taxation to the point where we start to run the sort of budgets surpluses? I think that's broken. And really, what you're looking at is, and which is the policies that is to almost inflate the debt away, and that's over long periods of time, where you're actually the economies are running at a rate of inflation which is above returns, and is gently eroding the value away over a period of time.
Well, we're close to that on long maturity bonds right now. We're not far off that, really. I mean, if you take 30 years, if inflation was to pick up even up to 2%, over that 30 years, you would have seen a lot of that value disappear, wouldn't you? With very low interest rates, if low interest rates remain in the meantime. Of course, if the Bank of England is holding on to those bonds, then the interest rates that are paid on those bonds by the Treasury don't really matter too much, do they? Because the Treasury runs, is operating the Bank of England in effect. So is that money paid back? Does that money sit on if it's not sitting on the open market, does that have to get paid?
They can ultimately do what they want. I mean, they can see fit, and they obviously have to be sitting independently of fiscal policy, of what the direction of travel is for the government at that stage, who will largely dictate the process that's going forward for the economy at the moment. I still think we're stuck in that mindset a little bit that we'll get through the pandemic, and then we're going to start to increase taxation, and we're going to start to. But I can't see that gap closing sufficiently. I can only see continued deficits, continued increases of the debt burden.
Well, if you listen to the voices from the government, it's all about building back, isn't it? So we're talking about new green jobs, new green infrastructure. All of that obviously is going to take even more. I mean, there'll be some private sector investment, but it's going to take even more government money. It's going to get worse.
Yes, and this is only sustainable whilst you keep the financing cost of debt to zero or less. I mean, it's only sustainable in that environment. But of course, it's therefore no surprise when you see the effort that's going into making this happen, and the continued effort that's needed over the next few years to make it happen, that it's obviously dominating the government debt markets at the moment. It makes it almost uninvestable capital for many, pushing that capital into other assets. And of course, if you cannot earn a return out of your core financial assets, then everything else gets repriced. And what I mean by that is that if you've got nice businesses that are generating an earnings yield of 4, 5, 6% because you're paying 15, 20, 25 times earnings, what stops the PE ratio on the market going to 50? Because earnings yield coming back to 2%, earnings yield coming down to 1.5% in the fullness of time. And so the argument here was, because of that backdrop, because I can't see the easy way out of it, and the continued need to maintain that high level of support, life support to the economy in the background, that financial assets get repriced. And when you've got all of this cash around and repricing of assets, by buying assets with limited supply, which are the commodities, just think about what's going on in the commodity markets at the moment. There's some real telltale signs in power markets, in oil, in copper, in some of the rare earth metals, and that you can suddenly see this supply, limited supplies and unlimited amounts of cash is pushing commodity prices. It's pushing inflation heavily through the system at the moment, and these are things that your normal mechanisms for putting the brake on inflation, which is interest rates, is coming at a time when the world just cannot afford the rate.
We're not going to have them for a long, long time, and that's why even we're hearing now people are even looking into riskier bonds, corporate bonds, triple C rated bonds, what we call the junk bonds, because of the expectation that maybe they'll come good, and maybe it's justified in some cases because some of these might have high debts which are circumstantial rather than an intrinsic part of their business, so they might pick back up. But how does all this end? My first question: when does it all turn? Because everything can't go up all the time. You've explained very well why this is happening, because there's just no interest rates, and they're going to have to stay that way because governments aren't going to want to see them rise. So how does it turn? I mean, assets can't keep on rising, and if they don't keep on rising, where does the money go?
Well, I suppose the question is how far can a central bank go? Ultimately, the US central bank can print sufficient money for the world to operate where everyone gets paid, everyone gets everything gets paid, every asset is owned. They can go that far. Now, obviously, we're not talking about that, but what we're talking about here is that we're obviously in exploratory phase at the moment. We're moving economies comfortably through this period of this sort of key measure of 100% of GDP. We're going to 150% of GDP. In Japan, we're going to 200, 250% of GDP at the moment, and nothing seems to be breaking. And it's not breaking because of rates. And there is an argument out there to say that you can see that by opening up that particular channel, opening up the door to increased government spending, significantly increased government spending, more government support for the economy, that we've seen in spades during the pandemic, but continues for year and year afterwards, to ensure that a relatively full employment is maintained within there. And it buys time until somebody comes up with a better idea, but we don't seem to be coming under any financial pressure. We could, and we're heading into that scenario where, the debt in the UK, which has gone through 2 trillion, goes to 2.5 trillion, goes to 3 trillion, goes to 3.5, and that actually, nobody's talking about MMT, but we're actually talking about the fact that, well, it was very financeable because interest rates are at zero, and we may have a long way to go. But what it does do.
It is halfway to MMT, though, isn't it?
It is. I mean, there's no direction. Good question. It heads in that direction. Nobody wants to talk about it, but that is obviously the direction of travel. But the question, of course, is how does it turn on its head how you value any asset that can create an income? How do you price the asset? Because actually, what you really want to do is own assets that can drive income going forward, and what price are you prepared to pay to deliver that income relative to a market that if you buy some of the inflation-linked bonds at the moment, you're really committing to losing 20 or 30% of your capital over the duration of that bond, and people still see value in that. They still see value in those type of assets, and all I'm saying is that as that mentality sweeps across other asset classes, you can see the melt up on that. And the equity market, the stock market, and traditional assets and that are generating income were miles off the spectrum for lagging badly against other asset classes. The UK stock market relative to UK property was always felt like a bit of a laggard over time, but more and more interest is coming into the stock market, and for somebody who's been in the stock market for 30 years and laboured, to be candidly, over an asset class that has been the poor cousin to lots of other asset classes, is quite excited to see a new generation that's coming along, and companies like Robinhood, for example, that are creating this sort of environment. I mean, obviously, lots of work to be done, education, regulation, and things to sort of help the process. But you can see that there's interest in the equity of corporates, and that for me is all good. Well,
all good news. Yeah, exactly. And I guess also, if the government is spending its money wisely and is investing in the future, so that we are investing in future productivity for the country, then that provides returns. If they get the private sector involved in that as well, that creates investment opportunities. That's the only path out of this, isn't it? It's a government money for good returns that can also involve some of that money which is having difficulty finding a home that's going to give it a return. If the government says, well, okay, green is the future, it's going to be a good return, it's going to be more efficient for the country as a whole. We might even lead in this. Then put your money behind this. That's a good route to take.
Yes, I mean, obviously, when you have government legislation that's driving an objective, be it the green objective, for example, then there's lots of work to be done and lots of room for capital to come into that environment. It's not necessarily the case that it will be highly profitable capital. Governments have not in the past been the best creators of value, and saying, well, we've got a bright idea here. Where the real value has come over the last 10 years has been where, if I could sort of put it into context, that the generation that really benefited from the movement in interest rates from 10 or 15% in the early 80s down to zero in the 2010 and saw the value of their assets increase, pushed their lifestyles to a level which is unobtainable by the next generation coming through. And so what does the next generation do? Do they sit down and moan about it, or do they look at how that generation lived its lifestyle and says, well, we can do that, but we can do it a lot smarter and a lot cheaper? And the deflationary aspect that came in and kicked in was the technology in from the mid-90s through, because it just replaced everything that we do, and it did it a lot cheaper. And inertia in the way that people do things, meant that it didn't happen overnight, but over 10 or 15 years, you realise that actually old business models had to transition, and we're going through that process, seeing it. What we're not seeing at the moment is remarkable new things that we all need. To be candid, in houses, largely what we've got, it's not like you needed new cookers coming along, refrigerators and things that rapidly changed economic progress. What we've been sort of dealing with is upgrading over a period of time without new things. And so I think it's entrepreneurialism, it's generations coming through and thinking about is going to be the key capital creator.
Absolutely.
And it won't be government through legislation.
No, I'm with you on that, absolutely. And I think we're going down a whole new avenue here, which would take another half an hour to explore. Look, Paul, I've taken enough of your time already. It's been very entertaining, very insightful. Look, I hope we can talk again soon. Thanks for your time.
Very much. Pleasure.
Interesting stuff, isn't it? These are very interesting times. Thank goodness there is a daily podcast to keep you across all of these thoughts. That's it for today. Back again tomorrow morning. See you then.
It's the Business with Phil Dobbie. Listen online at itsthebusiness or wherever good podcasts are found.